Howdy, folks. It is Dr. Jeff Camarda. It is the afternoon of April 29th, Thursday, and I'm very, very honored and gratified to be joined by my partner, Rick Dwyer, who has merged his investment advisory and financial services practice with ours. And I'm really, really excited for him to share with you some of the investment methodology that he has used for a very long time. Of which he and I are quite proud of, that I think that you'll be very excited because we're employing this for Camarda portfolios going forward. In fact, we have for a bit of time already. So I think you'll find it very, very exciting and very informative. And Rick, would it be okay if I kind of ask you a couple of questions about how you're guiding portfolios?
Oh, absolutely. Look forward to it. My favorite topic.
Good, good. And you're very good at it. And so you have used a little bit different approach than the textbook dogma investment methodology that I was steeped in my CFA and PhD studies. Reversion to the mean and buy and hold and indexing and using fundamental analysis to look for value. You haven't been doing it that way, right? Your approach is a little bit different. So why don't you tell us kind of what your investment guiding lights are, if you don't mind?
So I'm going to use a word that you and I have come up with to describe what we're currently doing called, elite investing. And what does that really mean? Well, instead of following some dogma, as you put it, like random walk theory or the efficient portfolio theory or any of the other numerous theories that are out there that kind of tell you what should be going on, what should have happened, what could have happened, we're more based on what's actually going on. So how do we do that? Well, we're looking at a number of indicators that we have, but they're effectively broken down into three time frames. We have our short-term time frame, which can be anywhere from daily to weekly, but quite frankly, it's more weekly to monthly. We have intermediate, which can be months to years, and then we have our long-term, which is really years to decades.
And these are, please forgive the annoying noise, folks. This is live. But these are indicators that kind of tell you what the market is doing and may do, kind of some advance notice of changes in the wind, as it were.
Yeah, so I mean, a great way to look at it is, let me just use the S&P 500 as an example, because a lot of people, when they come to see us, as you know, they have portfolios that are usually made up of mutual funds, and quite frankly, they think they're diversified because they have all these different mutual funds. Well, the reality is that a lot of the mutual funds, when we get done analyzing their holdings, they're just really highly correlated to the S&P 500, and quite frankly could probably get the same impact of holding just one ETF or mutual fund of the S&P 500. But when you own that, what do? You own 500 pieces of individual companies, and some of them are doing really good, some of them are doing okay, some of them are doing not so okay, and some of them are doing really bad. So effectively, you own the good, the bad, and the ugly. And when you take all of those returns combined and put them together, you get your annual return for the S&P 500 for that year. So that is one way to do it. You own the entire S&P 500. Well, we prefer not to do it that way. And so we want to avoid the bad and the ugly. And we have the good and the ones that are doing really good or excellent in our list of holdings that we're looking at, whether it's individual holdings or it's sectors. So does that answer your question? You want me to go into more?
Obviously the S&P has had some really good years and had some really bad years, not recently. Maybe that's coming. I think the essence of your approach is to really maximize the good times, but avoid the real big downdrafts, right? So we use a number of models that we emulate. We can't talk about specifically Camarda performance because of the SEC the regulations, but the models that we use and apply in our portfolios have really done a little bit better than the S&P, right? Did you want to talk about some of those?
Yeah. So that would be an understatement, but I think the philosophy can be summed up like this. you don't have to dramatically outperform the market. What you need to do is outperform it to the downside. In other words, if you avoid those large drops, if you're able to sidestep when the market is really hemorrhaging, then you're going to avoid those large drawdowns in value, and then you don't have to make them up over time just to get back to where you were. And for those of you, and I'm sure quite a few of you experienced the 2000 to 2003 and then 07, 08, or rather 09 drawdown, we know that after each of those, it took about 5 to 6 years for the market to recoup itself to back to where it was at the prior high. So if we can avoid that, that means we get back to where we were much faster, and we start making gains above and beyond what the S&P is capable of.
Even after the NASDAQ crash in 2000, it took, like something like 15 years, I think, to break even. So do you have any graphics? Can you show us kind of some of the models that you utilize look like?
Yeah, so I'm going to pull one up right now. And this is our longest term indicator, which is really in the years to decades time frame. So I'm going to show you up above. And so we had 4 out of the market signals since 2000. And
you going to put a graphic up?
Oh, shucks. I guess I should share the screen so you know what I'm talking about. That'd be an awesome idea. Hold on one second. Let me share the screen. Is that better?
There we go. Excellent. Okay, so I see U.S. equities bull bear indicator.
Yeah, so what this is actually showing us, as I was just saying, is that we had 4 signals to get out of the market in the last 21 years. And let's go back and revisit what those signals were. So in October of 2013, October 13th of 2000, we got a signal to get out. And then we got back in March of 2003. We got another signal to get out in January 11th of 08. And another signal to get back in May 15th of 2009. And then we had 2 more signals, one in 2011, get back in 2012, and another one get out in January of 16, get back in July of 2016. So
and
now,
this is the same indicator that we're using in our bull bear portfolio now, I think, right?
It is, and it's our long-term indicator, and it actually has implications in a few portfolios, but this is the one that's trying to show us long-term trends. And as you can see, it doesn't change very often. 4 times in 21 years is not a lot of movement. But let's see how this overlays into the actual S&P and how it performs. So I'm going to scroll down. You can see these shaded areas, and we'll just see how they came in on the graph. So you can see that if we look over here on the 2000 to 2001 timeframe, that we weren't at the high, so we didn't get out at the high, but we did get out pretty close to it, and then we did not get back in until several years later. And that's the key thing about this strategy that we implement. It's a rules-based strategy, and what this is showing you, it's not that we were out of the market totally, we were in different sectors, but from a strategic standpoint, we knew that the market at that point was in a major drawdown, and we were very cautious on what we were doing. And we didn't get back in until, as you can see, after the bottom was hit in around late fall of 2002. It tested that bottom again in 2003, and we got back in shortly after that.
So we can't expect to get out at the absolute high or get back in the absolute bottom, but if we're close enough, it makes a huge difference, right?
Yeah, and if we do get out at the absolute high and get back in the absolute bottom, it is sheer happenstance. I mean, that is not the, that's a goal, but definitely not part of the plan. We want to get out and to really sidestep these major drawdowns. So in 2008, you can see we got out in early 2008, and we did get back in May of 2009, and the market bottomed in March of 2009. So we were not in at the very bottom, but we got in pretty close. Now, in 2011 and 2016, we had some outside disturbances in the market, and one was around interest rates and inflation, and the other one was around Brexit. And the thing that people have to remember is that when we're starting to see things break down in the market, we have no idea at that point how severe is it really going to be. And as a result of that, our philosophy is let's sidestep the danger. We may give up a little bit of upside while we do that, but what we're trying to do is avoid those substantial drawdowns that can decimate portfolio wealth. And especially if you're in retirement, I mean, that's the least amount of time that you have, or the worst time rather, that you can afford to have your account really decimated. So we'd rather take a little bit of sidestepping action and seek some safety, make sure the coast is clear, and then re-enter.
So with this indicator 4 times in like 20 years, 2 of the, it flashed, kind of not a very useful signal that didn't make much of a difference. But the other half of the time, it made a huge difference, right? So what kind of returns, if you had followed this indicator verbatim, would an investor have realized compared to the S&P 500?
Yeah, so we actually have a few other indicators that we actually have to talk about to be able to really kind of codify that answer.
Okay.
And so let me show the screen here. So this is as of this morning. We get our signals every day. We generate our model portfolios and we reevaluate, because although some of our models are meant to be reallocated monthly, others quarterly, that doesn't mean we don't make changes intra-quarter or intra-month, and it's strictly driven by these indicators that we have. So for an example, for a period of time, we had this very short-term indicator went negative, and it really just went positive yesterday. So it's been positive for 1 day. But if you look at bonds as an example, we've been bearish on bonds and out of bonds since effectively February of this year. Energy and gold are also negative for us. But our other main sectors that we're following on the bull bear side anyway are still all positive. So all of our indicators are still positive, so we're all in on the market. If this particular indicator goes red, then we use that as a signal to kind of indicate, should we be allocating new dollars at that point, and if so, how much, based on what the other indicators are doing. This particular one, this cash one, I just would like to take a second and talk about with you, Jeff, if that's okay.
Sure.
So what cash is telling us as a sector is, what is cash doing? And if you think about it, it makes sense. If the institutions are taking money out of the market and putting it into cash, what do you think that's telling you?
They're getting out of stocks, obviously. They're expecting, adverse conditions.
Correct. So they're sensing something's not quite right, whatever it is that they're doing, and they're taking money off risk and putting it into cash.
Now, when you say institutions, you're talking about the biggest investors that control, most of the money in the market, right?
Correct.
So we're talking about really, they have a huge impact.
We're talking about institutional dollars. That is correct. So if institutions are going to cash, that's a very bearish signal.
Anyway, to segue, and thanks for all that detail, some of which we've deleted because I think it may be too technical for some of the clients. But I'd really like to drill down on some of the performance that these models have been able to deliver to people that follow them in the past.
Okay,
now,
perfect.
Which one are we looking at now?
So this particular model is made up of individual holdings, and we hold anywhere from 7 to 20 at any one time. We have a universe of around 30 stocks that we're looking at from the S&P 500. So as we said earlier, you have 500 holdings. Not all of them are doing good. So we're only focused on the top 30 performing equities positions in the S&P 500.
And this is the one that's in the tactical opportunity portfolio that we talked about last week in the video, I think, right?
That is absolutely correct.
Okay, good. Thank you.
So with this portfolio, what you're seeing on the blue line is the portfolio's performance itself over the last 10 years. We started with 100,000 in 2010. And as of the end of 2020, it had a value of a little over $1 million and just under 24% compound annual growth. If you'd been in the S&P 500 directly, you still would have done well. You would have averaged 14%. You would have had an ending value of 424, almost 425,000. But the difference is you would have had 150% more money by following this strategy.
That's huge. I mean, that's like 2.5 times the money, right? 400 to over $1 million. So, and that's also not the regular S&P 500 index, right? Total return is a little higher hurdle.
It is a higher hurdle because it's including distributions, with the S&P 500 cash does not. So yeah, we're trying to be very conservative in our approach to how we benchmark this portfolio. And as you've heard me say before, Jeff, returns are great, but how much risk are you assuming to get that risk? I mean, to get that growth. And what I'd like to point out here is that our risk on this portfolio during that 10-year period was only down a maximum drawdown of less than 19%. And that happened in 2010, where the S&P had a maximum drawdown of almost 34%. And that was during the COVID crisis, where the economy came to a grinding halt. So to sum this up, we had substantially more growth with almost half, not quite half, but almost half of the risk. So we outperformed to the upside, and we dramatically reduced the risk for our clients at the same time. Why? Because we only
or not necessarily Camarda clients, but folks that would have followed this model, and that's after an assumed fee of 2.5%, right? A really high fee.
Correct. This was just to make things very simple. We just put in a 2.5% fee. So no matter how much money you had, we're not including any break points in here at all.
All right. And I guess the other thing is to emphasize that S&P total return index is a higher, most managers compared to the S&P, but they don't, include invested dividends and so forth. So the S&P 500 return that they show is lower than this one. So this is really, it's really impressive performance. And this is just over 10 years, right? How did it do in the bear markets of the first decade of the century?
Okay, so
I don't want to talk about that because it's almost, beyond belief, but look at that.
Well, we talked about that. You don't have to make a lot of money to outperform the S&P as long as you sidestep the big drawdowns. And what you can see here in this mountain graph below, the black is the S&P 500. And during the 2000 to 2003 area, you can see that it drew all the way down to around the minus 40 something percent range in 2002, and then retested that in 2003. And as you can see here, it was 55.2% was the maximum drawdown in 2009, March 9th. That was the bottom of the market in March 9th of 2009. We've been in a bull market ever since then. But look at our
that's pretty amazing. So if you had invested, I guess, what is that, $100,000, something like that, in the S&P total return in 2000, it'd be worth $424,000 recently, compared to 7.6 million. Are you sure you haven't skipped the decimal place there, my friend?
No, I'm positive we didn't skip any decimal points. That's how this model, this is how the model behaves. But look at this. This is the other thing to look at. The compound growth rate, because of those drawdowns, dropped from almost 15% in half over a 20-year period. And then our return on this portfolio actually improved slightly, but not really meaningfully. I mean, I think just under a point. But still, the more important part to me, and it should be to the clients, is you not only got the returns, but we did it with substantially less risk. Now our risk is about a third of what it was for the S&P 500 during those massive drawdowns. To me,
risk is defined as the reduction in value rather than some esoteric concept like standard deviation. I just want to make sure that I got what you said right. So compared to the 10-year period, the S&P over 20 years actually did worse, but this model held up about the same.
Yeah, correct. Here's the 10-year again. The return was 14. The risk was 33.8 or drawdown. And then for the 20, the return was 7.5%. And then the risk went up to 55%. So let me just define risk really quickly for everybody. So when we're talking drawdown, we're talking how far did the market drop from the previous high to the next low. And it's that differential that defines your drawdown. And so when the S&P dropped 55.2%, that was from the high set in 2007 to the low set of March 9th of 2009.
Gotcha. Now I see some other tabs up there: tactical opportunity and versatile opportunity. What, or rather, market Are there other indicators that we have applied to the new Camarda portfolios?
Yeah, so the what this is showing just a different blend. So on our blends, we have different models that we can put together. So in addition to having the individual stock portfolio that we have in the tactical, with the versatile, we actually blended in a sector rotation portfolio. And as you can see on the 20-year, our returns are a little bit less than what we had on the tactical, but our drawdown went down a little bit. So instead of being in the 18% range, we're at 16.1, and it happens to be on still the same day, May of 2010. And the drawdown for the S&P 500 is still the same, 55.2. So we were able to reduce the risk a little bit. And some people don't want to be in just an all stock portfolio. So here's an opportunity to blend a sector model in addition to in addition to an equity based model.
So which is more diversification with ETFs and mutual funds and that sort of thing, right? Asset class diversification.
Correct, except in this case, we're only focused on the top performing sectors versus all sectors.
And there's a separate indicator regimen that's used to determine which sectors appear to be most attractive, which we use in our sector rotation portfolio we talked about last week.
Yeah, so when we looked at this sheet earlier, when we look down below, when we look at most portfolios, as you know, Jeff, when they come in, it's not uncommon where people are in large cap growth, large cap blend, large cap value, international, emerging markets, and bonds. Well, those are all down here in the red. So those are the areas that people should not be in. But unfortunately, that's what's done well since the bull market started. And most people have just never reallocated. And that doesn't matter whether it's their individual account or their 401k account. They just keep it right where it's at. And so they're giving up not only upside, but they're taking on a level of risk that they just don't need to be doing.
Yeah, that's certainly an extremely, extremely impressive model. I got to tell you, Rick, that this is, I've been dragged kicking and screaming, I guess, to believe in technical analysis. Kim has been a long-time market technician at Chartist, but it's just amazing the difference, not only in performance, but in downside protection. Getting out at close to the right time just makes a huge difference in overall wealth.
Yeah, I think the important part to note is that we're not always going to be, perfect. We don't always outperform the S&P 500, and we don't always have stellar returns. So, for example, on this one, I'm going to scroll up just a little bit. I mean, in 2019, the S&P actually outperformed us by almost 12 points, and then we got outperformed by 5, almost a little over 5 in 2017. And there are going to be some years where we're really close as well. So that just goes with what we do. There is no perfect utopian system out there that's just perfect all the time. But when you take our returns and look at them over time, and in addition to that, see how we sidestep those major drawdowns, that's what's really contributing to our CAGR. And yes, we have had some stellar growth opportunities throughout the years as well, mainly because of our primary focus on being in just the main or the highly performing sectors and the highly performing stocks, and not just buying into a basket and hoping and praying that everything works out.
And a CAGR, of course, is a compound annual growth rate. So again, just to emphasize, if you look at that bottom line here in the chart underneath the graph, the secret sauce has been just avoiding the major downturns and not, staying invested while things fall apart. So if you look at, the losses avoided in 01 and 02, but still capturing some decent returns, like 08, up 25% versus a loss of 37%. That's really, to me, where the difference is. And so even if you don't do quite as well in every year, avoiding those major downturns, well, I mean, you see the difference between $4 million and $400,000 over a 20-year period just speaks for itself.
Yeah, and once again, it's going to just come back to that, staying with the top performing sectors, top performing stocks, and avoiding the massive drawdowns. And we're not going to be right all the time. So we could have a drag on earnings. If we look at 2011, our return was only 3.4%. If we look at 16, we still had a good year that year. We did outperform the S&P, but we would have had better if we hadn't got out. But the reality is that's what the signals told us to do. And I'd rather be wrong and err on the side of being cautious and getting out and avoiding a massive drawdown than to be in and watch my portfolio have this big, dark, black mountain on the bottom where we know that we're just losing half of our wealth that could have been avoided.
Yeah. So to sum it up, really, it's not, the discipline is the same, but the discipline is not buy and hold or buy and pray. It's follow the system. And even though every year is not going to be a stellar winner, cumulatively, if you stick with the discipline, or at least had stuck with this discipline, you would have done really, really well. Any other, jewels of wisdom or pearls that you'd like to share? Because this has been a pretty long video segment, so an exciting one. And I'm glad that the clients and others are getting a look at you and hearing about your intellect and your skill set, which we're really, really gratified to have joining the Camarda team. But I'm sorry, any other pearls of investments that you'd like to impart?
Yeah, I think you touched on it a second, so I just want to drill on that. People have been taught for decades that buy and hold, the market always comes back. And while that's been true, you don't need to hold through these massive drawdowns. There are techniques, there are signals that will allow you to sidestep these drawdowns. And I would rather be up here in the market and just sidestepping all of this. And when the market comes back, step back in instead of having to be way down. This graph is so far out of kilter because of the differential in returns. We can't even show it on this graph, but I'll sum it up with this way. Buy and hold is not the way to go. How's that?
You're saying the difference between the S&P and what this model delivered is so great you can't show it all on one screen? I guess
yeah,
we need a log chart, huh?
Yeah, the S&P looks like a flat line. That's the problem.
Yeah, and that mountain's pretty high. Well, that's outstanding job, Rick Dwyer. Thank you so much for that explanation. I'm sure that all of the clients across Camarda land are very excited by your bringing your skill set and this methodology to the portfolios that we manage for them. Any other parting words of wisdom?
No, I think if anybody has any questions, they should feel free to reach out to us, and be happy to go into detail on what we do and how we do it.
Very good. And of your personal wealth advisors, PWAs, led by Troy, who was really just outstanding, have all been steeped in this methodology. They sit on a portfolio management board. They know what's going on, and they can explain it to you at a very high level. And if that's not enough, then of course Rick and I and Kim, really Rick and Kim, I think, are probably more adept at it than I am, are very happy to answer your questions. And by the way, upcoming book, remember, we got a big book coming out probably this summer, maybe fall, depending on Macmillan. We saw some cover design drafts last night, and we're excited. But anyway, there's several chapters devoted specifically to this methodology in the book. So we're drinking the Kool-Aid across the camp. And with those warming words, we wish you all a wonderful evening. Until next week, this has been This Week in Wealth. Adios.
Adios.
Thanks, Rick. Great job.